Comrades, thank you for inviting me again to the Communist University. It's always a pleasure to attend and participate and present arguments, either in debate with others or to present my own point of view. Normally I go on about the rate of profit interminably at these meetings, but I'll only start with that and then move on to something else, which is to deal with the immediate situation we've had with the British people voting in a one-off referendum to leave the European Union, but without any clarity about what will happen after that. And one of the features of the question of what will happen after that is if Britain is to come out of the European Union and all the trade arrangements that the European Union has with the rest of the world and all the other international trade agreements that are around the world, and they're going to renegotiate those or perhaps build new trade agreements with different countries or regions, what will that mean for British capitalism and what's involved in that process? Because I think one of the ironies of the Brexit vote has been it looks as though, because of the Brexit vote and because it's now unclear what the UK's arrangement with the European Union will be in terms of trade and free movement of labour and capital, then some key international trade agreements which are underway at the moment, the Transatlantic Trade Investment Partnership, known as TTIP, which is between Europe and the US, and more recently the TTP, its twin sister, as it were, between Asia and the United States, which has been agreed by governments but not formally approved by any of their parliaments yet. And the European US agreement is now, at least in, as it were, being put back on the shelf and possibly delayed and maybe forever, certainly through into 2017 as a result of the EU vote. So it's an opportunity to consider this, and towards the end of what I've got to say, I'll concentrate a little bit on what's happening to the British economy in relation to the rest of the world to see the problems that British capitalism faces on that. But one of the reasons we now have a range of regional trade agreements is because the World Trade Organization and the World Trade Organization's international total world agreements, starting with GATT, then going on to the so-called Doha round and others, have basically come to an end. They're defunct. There is no move to reduce tariffs, to reduce regulations between trade of goods and services around the world on a global scale, or to consider ways in which multinationals might be able to move more freely around the world. There is no international process towards reaching a world agreement on that. Now we have a move towards regional agreements, with the US, as I say, leading one for Asia and also one for Europe. And I think one of the indications, the reasons for this, is I think one of the big developments in the so-called neoliberal period of capitalism since the early 1980s to the end of the 20th century, perhaps a little bit beyond, was what we call globalization. One of the big developments was the reduction in tariffs, the reduction in regulations, the opening up for the movement of capital, to some extent labour, but mostly capital, and goods and services across international boundaries without the normal national government restrictions being placed to protect sections of workers or sections of industry in those countries. The argument was that globalisation brings benefits for all because it increases trade and everybody will gain. It's not a zero-sum game, some people losing and some gaining, everybody gains, and that was the mainstream economics theory, really, based around what is called the theory of comparative advantage. Everybody comes into the trading market internationally with certain advantages. Maybe you've got a lot of unskilled agricultural workers galore, and you can use those to develop agricultural produce while somebody else has got, some other country has got an advantage in finance, as we supposedly have in Britain, and they can take advantage of that. And there's an exchange of products or services, and everybody gains through international trade, such as the mainstream economic theory. Globalization was supposed to, in the last 30 years or so, supposed to open that up. Well, has it done so? We'll discuss perhaps in the course of that, and whether things have been gained from that. I'll make a few points on that. But what the most interesting part of the development of globalization, in my view, to come back to my hobby horse, was it was part of the process of trying to restore the profitability of the major capitalist economies that declined in the 60s and 70s to the early 1980s. That by trying to spread beyond national boundaries to develop international trade and capital movements, the big multinationals could try and restore the profitability that had fallen at home, and that they could rely upon the surplus labour available in the so-called emerging economies, with lots of supplies of rural labour coming into the cities. They could expand into new factories using that labour and get a very high level of profit, which they could transfer through multinational and transnational corporations, the profits back home insofar as they wanted to, depending on the tax arrangements, and that way they could restore the profitability of the wide sectors of the economies of the major countries. So one of the counteracting factors to the falling rate of profit, there are others which we've discussed in previous years, and no doubt you've discussed as well, is the development of international trade. One of the things that Marx pointed out as being one of the 5 or 6 counteracting factors to the tendency of the rate of profit to fall. And globalization is an extreme example of that. We saw a similar period from the period of the early 1890s up until about 1910 of a huge globalization then, where British capital expanded around the world in order to compensate for the depths that profitability had fallen during that first late 19th century depression at the time. And other economies like the US and Germany to some extent benefit, but particularly British capital through the globalization period that took place now. But it would seem that now that situation is changing. Globalization seems to have stuttered. Not only have the world agreements gone, but also world trade is no longer expanding to provide the advantages that could be gained from going abroad if things are difficult at home. So if we look at this graph, we can see that the trend in global trade, this is from 2000, during the period before the crash, was going up very nicely, and then suddenly we're now on a new trend. See where world trade has dropped down below the index of 100, has recovered to some extent, has moved above the previous levels, but is nowhere near the original rate of growth. For the first time in 4 years in a row, world trade growth is less than world GDP growth. That's unprecedented in the whole period of the post-war period, which shows that trade is not a way out for capitalism at the moment as a result since the Great Recession. If we look at world trade volume, we can see before the Great Recession it was going at about 5.7% a year. GDP growth in that period on a world scale was around about 3, maybe a little higher, but about 3. And since then, world trade on average has been growing at 2.7% a year. World growth has actually been growing around about 3, including China, that is, and India, to get that 3%. And now, in the very latest period, up to May 2016, I managed to squeeze it up to, we can see that we're in negative, virtually in negative territory for world trade at the moment. It's really weak. We can see briefly in the recession of 2001 a similar collapse, and in the course of the Great Recession a huge collapse in world trade. But here, before we've even got to a major world recession again, global trade is struggling to even move up at all, let alone keep up with GDP growth. And it's not just trade. If we look at perhaps even more importantly, at the movement of capital across the world, global capital flows between the US and Europe, Europe and Asia, between the South, the emerging economies of the South, and the advanced economies of the North, if you want to use a geographical description, between the imperialist, concentrated advanced countries and the periphery in the world. Global trade, it was also expressed in huge movements of global capital. That means foreign investment abroad in factories and machinery, but also investing in financial assets, in bonds and equities, and also just shifting cash abroad in order to look for opportunities for profit. So you can see between 1970 and 2000, we have a gradual increase in global capital flows, but during the great credit boom, from about the end of the 20th century up until the recession, this goes up to 2007, we have a massive increase in capital flows both into countries and out of countries. The second graph shows the same thing up to there, but then shows you what's happened since the Great Recession, a complete collapse in that level of growth, back to levels that we haven't seen since the 1970s and 80s, before globalization. So not only is world trade stagnating and even beginning to contract, but also global capital flows, which is vital towards the development of the profitability for capitalism on a world scale, has also dropped down to levels before the neoliberal period that we've been involved in for the last 30 or so years. Now, these new regional trade agreements are obviously an attempt to reverse that process, but also to re-establish the opportunity for the big multinationals in the imperialist countries to gain some increase in profit, which is beginning to fade away and is no longer available through the previous methods of globalization. In fact, TTIP and TTP, in my view, are really an attempt by the US in particular, but other major capitalist economies, to stop the decline in global market share, which they're suffering at the expense of the likes of China, India to some extent, and some of the other emerging economies, and even in the case of the United States relative to Germany. But primarily to stop the growing market share in goods and services, as well as not just goods, but also services that both China and India, these emerging economies, have had over the last 10 years. So these regional agreements, when you look at them, are designed precisely to increase the market share of the imperialist countries and control and cap the market share of the likes of China. In 1985, the proposed TTP countries, that's the 12 top countries in the world who are negotiating the Asia-US agreement, which is mainly Japan, the US, and the peripheries of Asia like Korea, Taiwan, and so on. Back in 1985, they had 54% of world GDP. Now, they're negotiating a deal where they only have 36% of world GDP. So they are desperate to do something about the situation where there's a decline in their share of the total value and surplus value in the world. And the purpose of this agreement is clear, that China is not involved in this deal. China is specifically excluded from this deal, and all the trade negotiations and reductions in tariffs and regulations and improvement in opportunity for transfer of services and capital and all kinds of other measures we've perhaps got time to deal with are designed to keep China out. So they're not involved in this process and can't make any gains out of this. So we have a situation now where the real character of the TTP is coming clear, that the 12 signatory countries, which are the US, Japan and Canada in the case of the Pacific one, plus Australia, plus Mexico, Malaysia, Chile, Vietnam and Peru, the emerging economies make up 8%, and the top imperialist countries and Australia make up 90% of those involved in this deal. So this is a deal to improve their position against the rest. But also, these agreements are an attack upon the ability of national governments to preserve the interests of their own national capitalist class, and also, of course, it's an attack upon labour. When we look at the terms of these agreements, it becomes very clear. Now, for example, the EU is currently negotiating a deal with Canada, just with Canada, and in the terms of that deal, which also will apply to the European US deal, the TTIP, if it goes through, this will allow corporations to sue governments in a secret commercial investor dispute settlement court, and this exposes governments to lawsuits for any policy that they carry out which the corporations can show loses them profits. If I could give you a good example, which is a pretty ghastly one, if the Australian government decides that it wants to ban smoking in all areas of the country, Philip Morris could, under this new agreement, take the Australian government to court for losing its profits on its tobacco sales because they banned smoking in all public places. And they can go to a separate, secret court. Nobody is allowed to see what's going on, except the judge and the lawyers. And they could reach an agreement where the Australian government, on behalf of its taxpayers, would have to pay millions of pounds for Philip Morris because of the loss of profits through the banning of smoking in public areas. It's a similar sort of situation in the UK, if we have NHS and other deals which decide to improve the health of the population. If corporations are hit by that, pharmaceutical companies and so on say, well, you haven't chosen my drug, I can take you to court because you've lost me money in court. And that these new courts which will be agreed by this international agreement could thus apply in this way. This is one of the big developments, really putting a huge control over the ability of national governments to defend their interests. But also, it's going to be a big hit upon the working class itself, because many of the terms of these new agreements will do away with all sorts of labour market regulations and protections for the labour force. Things like zero-hour contracts will be automatic under the agreement. There can be no attempt to remove zero-hour contracts. There will be all the sorts of self-employed operations in the so-called gig economy will be regarded as a way to proceed, outsourcing all the rest of it. Nothing can be blocked under these agreements. And that's it, particularly in service areas which haven't been in before, like insurance and financial services and various other ranges of services, all designed so that the multinationals can get the cheapest possible labour and the maximum return upon it under international agreements, both sides, both European multinationals and the US. So the real aim here is to attack the working class under these agreements and increase profitability. Next one? No, not yet. Sorry. Under the US trade, a lot of the US and other governments say, well, don't worry, we make compensation. When we do a trade agreement and say all the steel workers are sacked, wherever it is in Ohio or somewhere, we spend money on retraining these people and giving them assistance so they can go into new occupations, because of course some people lose out of this. It's a trade-off, but we transfer them into the new expanding sectors and industries that come out of the trade agreement. There's the US Trade Adjustment Assistance Program. It has a budget in the US of $664 million. Well, that sounds a huge amount of money, but that's for every worker in the whole of the US who gets displaced under these trade agreements. It constitutes 0.04% of GDP in the US. Military and security spending to preserve markets by attacking countries that don't want to play ball on the needs of the oil companies cost the US 4,000 times as much as that. And that's the indication of the way in which money is spent, not to help displaced workers from an agreement perhaps moving out of old, unproductive industries into more productive ones. No money is spent on that. Money is spent, however, on the military protection of multinational interests abroad. So that $1 out of every 25,000 in US income generated by the US goes to help people who have been hurt by globalization. And they don't receive that cash directly, of course. They only receive it through so-called retooling and retraining, which supposedly give them new jobs. It's a very far way from the idea that free trade is going to help everybody in a society as a result. So that brings me a little bit briefly to a theoretical point I wanted to make, that the argument of mainstream economics, as I said before, is international trade benefits all. Yes, some people lose, but eventually they'll get into new sectors and everybody will benefit. Some countries will be able to use their advantages, the natural or skilled advantages they have in a trade deal, and everybody will be benefiting from that. That's the view not just of the neoliberal economists who are in the governments of the various countries, but also the so-called left liberal economists. Paul Krugman says, the Keynesian, the great majority of economists would argue that the gains from reducing trade protection still exceed the losses. However, it has become more important than ever before to make sure the gains of international trade are widely spread. How true? But is it true? The first statement is that everybody gains from trade protection, or overall it's better to have the trade-off because it benefits more than it loses. The right-of-centre economist, Greg Mankey, says, well, will trade make everyone better off? Probably not. In practice, compensation for the losers is rare. Without such compensation, opening up to trade, international trade is a policy that expands the size of the economic pie. It might leave some behind. In other words, his view is there's nothing, that's the way the world ticks, and more agreements is better for, he says, the majority, but of course we mean for capital, and for sections of the working class, if they lose out, that's too bad. Now, when we look at Marx's theory of international trade, we become aware that this isn't correct. What makes the difference between countries is not whether they have some sort of natural or skill advantage that they can bring into a trade agreement. It's whether they have the productivity, the investment at a higher level of productivity, which can deliver a price which can compete against other countries with lower productivity, with less investment, and less able to maintain a good price on world markets. Capitalism is a drive in competition, and it's not a drive towards cooperation, everybody benting for trade. It's competition between national capitals and between multinationals, and those that win are those with the better investment, the lower productivity and the lower prices. They build up market share, and also if they can establish a monopoly control of that market by various regulations or barriers to entry, then they can sustain their original advantage through monopoly pricing as well over a period of time. So it's demonstrably untrue that all countries benefit from international trade. If it was, and we can show that because we know there are a whole range of countries who lose market share, not just over a period of time, but for decades because they cannot compete. So the trade is not equalising the process, it's actually driving things apart. For example, the United States has run a trade deficit with the rest of the world for the last 40 years. There's an indication it's losing market share. So even the trade agreements that it's been able to get and they have still not been able to reverse that process, which is the underlying process that's going on. They just can't compete against the likes of China, India, Germany, and a whole range of areas. Of course, they can compete in certain areas, but over the whole, they are spending more to buy products to bring into the United States than they're getting back in terms of exports, revenues, and other services. And that, if mainstream economics is correct, trade agreements should bring about an equalisation. So there should be no surpluses and deficits over time. It should be more or less balanced over time. All right, short term it could be different, this is the argument. But over 50 years you would expect, say, the major economies to more or less be in balance with each other. They are not. Deficits continue to widen for some of these countries, and we could be the small peripheral countries, the likes of Greece and so on, have run deficits for decades as well. So they're continually under the pressure of having to finance those deficits with some means of capital coming into the country to pay for it. Because now, if I go to the next chart, let's look at the UK. Now the UK has been running a deficit, this is only back to 2005, but it's been running a deficit a lot longer than that. And one of the most important things about this deficit is it's now around, in 2015, 7, so 6, but it's actually in 2016 now, 7% of GDP. So, in effect, British capital is spending more than it's getting back in revenues on its trade and services, with goods and services with the rest of the world, to the tune of 7% of GDP. So it has to finance that deficit every year, 7% of GDP, and widen. So will these trade agreements that Britain may or not be in change that picture? Well, the previous ones have not done so. The question is, how do you finance that trade deficit? Because this is like an Achilles heel for British capital here, if this cannot be financed. And if we look at the next chart, we can see this is the other half of the balance of payments, as it's called in economics terms. Now the other half is, that 7% is financed by 3 different ways. Foreign investment into Americans, Germans, Japanese, everybody coming in buying our industries, Indians buying motor car factories, buying steel factories, and then closing them down, but buying them, so putting in foreign investment, foreign direct investment it's called, and that is money coming in, so that's part of it. Now that's the orange bit. So you can see from 2005, we have, generally speaking, the orange bit adds some financing of this deficit that we're running on trade. Not every year, not in the recession years here, but on the whole, it's only got back 10 years, so it's not been up far enough, but foreign direct investment is usually a plus. So foreign multinationals have been coming in and buying up bits of British industry or setting up new factories, Nissan in Sunderland, or whatever it might be over the years, and that adds to financing. The next bit, is, as you can see, is by far more important than that. That's portfolio investment. What's that? Well, that is big multinationals, banks, financial institutions deciding they want to buy British financial assets, which is government bonds, British government bonds, or shares in British companies that are quoted on the stock market. So that portfolio investment, net, which is the dark blue line, up until the crash, was pretty big. So everybody liked to plunge in and get into the UK market, buy up their shares of British companies, buy UK government bonds and other things, because they had a good return. UK government bonds used to have a good rate of interest compared to other countries. So that's, in fact, they had to in order to track that. Then we had the crash. You can see in the recent period that's still the case. We have currently a stock market and bond market boom, and people quite like, these foreigners quite like our portfolio assets, namely our stocks and our bonds, and the FTSE market and the government bonds. But it's quite a volatile thing. One year it can go right down, and the other year it's not very secure. What's other investment? Well, that's even more volatile. Other investment is basically what's called hot money. It is a bunch of Saudis putting their money into British banks in order to either hide it from anybody else or to get a bit of an interest, and the British banks then invest in around the world using the money that the Saudis have given us, or maybe it would be Asians and Russian oligarchs and various other parts around, particularly Asians, bringing in money, using the City of London as a conduit to dump their cash and get them to invest on their behalf so they get a high return. So the other investment is basically loans to British banks from abroad or deposits made into British banks to do that. But you can see that this has rather died. It was doing okay for a while, and it would be the most important. It's very, very volatile. But look what happened in 2015. We're now in a position where basically foreign banks and foreigners are taking their money out of Britain, their cash. They're not keeping it here anymore because they're not getting in much of a return because all interest rates have come down. And you can imagine what they're thinking about the question of Brexit now. This light blue grey line, the bar, is going to be much bigger in 2016. The portfolio one has probably been holding up a bit, and the other factor is the foreign investment one here. That's probably died as well, because if we look at the next chart, well, that just shows you the immediate impact of Brexit. Recently, the pound has collapsed, so if you want to put your cash into British banks, and you have to put them in terms of pounds, the pound has collapsed. You're not going to keep doing that. In fact, the reason the pound has collapsed is that people are taking their money away because they're worried about Brexit. And this is the investment by multinationals outside the EU into the EU. And the UK takes 21% of all the multinationals, American, Japanese, Asian, Chinese, 21% of all the FDI in the last 14 years goes into the UK, bigger than anybody else. Now with Brexit, the issue is it a good idea for a Chinese or a Japanese multinational to build a factory in Britain or buy a British company? If it's not in the EU, would it not be better to go to Germany, where you're in the EU, you get the EU free movement of labour and capital and all the advantages that EU regulations would have for a multinational? With the UK, we don't know. We don't know what's going to be negotiated. We don't know whether we can bring in cheap labour anymore from Romania and Bulgaria. Maybe it would be better to stay in Germany, where we can use the Turkish emigres that are coming in, rather than the UK, which is going to restrict this, or what other regulations that the UK is going to impose on multinationals. So there's a fear here. And that means that in trying to finance that 7% of GDP current account deficit, foreign investment could die. Portfolio investment may hold up as long as Mr. Carney goes on cutting interest rates and we can all buy stocks and shares and bet on the stock market in Britain. Foreigners can do the same. And in that way we can sustain sufficient funds to pay for that deficit. Because if we don't, then what will happen is that the pound will keep falling. It will fall further. Eventually that will start to hit prices in the shops because of all the imports that we've got. At the moment that's not happening, but we could begin to see that happen if that 7% of GDP deficit widens or the pound falls further, and we don't have the financing to cover that unless we just raise interest rates to sufficient height. Now, the Governor of the Bank of England, Mark Carney, the most expensively paid governor in the world, that we brought over from the Bank of Canada, because he was so successful in Canada, tells us that Britain it's only managing to hold its own with the rest of the world through, to use his phrase, the kindness of strangers. In other words, foreign investment, foreign purchases of our portfolio stocks, deposits in our banks, thanks to the kindness of Saudi sheikhs, of Russian oligarchs, we are financing that deficit, and we're able to maintain all the purchases we're making abroad of BMWs and all the rest of it. I know you've all got one, that enable us to have a great life. Now, if that's going to be more difficult to do because the strangers are no longer so kind, because they're worried about what Brexit means in terms of their investments and their returns on interest and so on, then Britain is facing a much more difficult position as it starts to renegotiate trade agreements with the rest of the world, according to, is it David Davis, the man who is going to decide this for us all, who tells us we don't need to worry about any previous agreement, we can start from scratch. I don't know where he's going to start. Maybe he'll start with the US and then Canada and work across the world gradually to build up a whole series of agreements, or maybe we can come up with a wider one. Nobody knows. And so the issue of what terms British exporters are going to be able to export abroad and what terms we're going to allow multinationals to export into Britain and to finance or buy our financial assets is still very unclear. I'm sure, as they've said, Britain is open for business. But what worries the foreign nationals, on what terms is it open for business? We knew where we were before, now we're not so sure. So there's a whole area opening up for British capital just at a time when these international agreements have collapsed, when world trade is in decline, when the world economy is still not growing very fast, and in fact has a serious risk of slipping back into recession, and where even the regional agreements, the international regional agreements that are underway, are now possibly being put on the shelf because nobody knows exactly whether they can be implemented and carried out over the next few years. So that is another aspect of what's happened from Brexit, which is yet to be explained, or we don't really know what it is going to mean for the British people in the next few years. On the GDP thing, I think the way I would look at it, if you imagine the GDP is made up of, to use the mainstream economics categories, consumption that we all make as households or individuals on goods and services, the investments made by industry and the capitalists and government to some extent, a small government investment, and the other aspect is trade. So what we do when we're adding up GDP is we take the net trade, which we take the exports, and we take off the imports, and if there's a net trade, that adds to GDP, and we add that in. Now, most of the time, in lots of countries where they're running good surpluses, they're getting a good positive gain from trade. Countries that are not getting a positive gain from trade have got a negative factor as part of their GDP, the trade bill. What we're saying here is now that with GDP, that means the bits that are not part of trade, consumption, investment, both government and private, are growing faster than the exports, and maybe in many countries what used to be a positive position is turning a negative or is not providing any gain to the economy. And lots of countries can no longer increasingly rely upon exporting to make compensation for slowdowns in the domestic bit. And so the escape valve of exporting when your own economy is not growing very fast is fading because everybody can't find those markets. Generally, exports are declining in growth than they were before. They're not growing as fast as they were before, and that means also imports because the two things are one side of the same balance sheet, and so you get a result where there's a slowdown in the trade part of everybody's GDP. So it can be compensated for by faster growth at home. So if you invest more at home, or people spend more at home on products at home, then that will compensate for that slowdown in net trade. But that's not usually the case. And if there's the sort of slowdown we've been getting in net trade over the last 3 or 4 years continues, then it's increasingly difficult for economies to grow at the same rate as before. They can't use trade as an escape valve for doing that. Now, yes, if these have these international courts which say, well, if you do something, if the government introduces a policy, for example, renationalising the railways, and that hits Dover, who's got a franchise for its wonderful service in Southern Railway line, then Dover could sue the British government for taking profits because it's broken a contract and we have this new international trade agreement where people can do this sort of thing. It's a possibility. Well, what Comrade says, well, you know, governments can just tell them to get stuffed. Well, yes, they can. Isn't that the point? It's a whole. We then reach the point, perhaps, where decisions made are in the interest of people. People will understand why you would break such a trade agreement if that's the clauses and what it leads to in terms of losses for the majority of a nation's population. So these agreements will probably, if they are implemented and approved by parliaments and begin to be used, and we do get to courts, we may well see situations where governments, or at least more left-wing governments, are prepared to break these agreements. On the other hand, we can expect, much more likely, that we should get a whole series of right-wing governments saying, well, I'm sorry, but we all agreed to this, and that's the way it is. I'm sorry, but Dover will be compensated. Philip Morris will be compensated for killing us all. And so on. That's the situation which will arise. It's another example, I think, pretty clearly why a lot of people are not very keen on international trade agreements anymore and prefer to think that they can run things at home without any contact with the international, with the world and the rest of other countries. And that, of course, brings us to that exact contradiction which now exists for the British government. It has found that it's got a referendum which says you've got to leave the European Union, and the reason you've got to leave the European Union is primarily because we think the European Union is full of regulations that's destroyed us, and also because European Union means that anybody can come into our country and take our jobs. Or so the argument goes. We know that this isn't the reality of the situation, but these are the factors that drove the perception particularly. Well, as we know, if we look at now the data, we know who voted for Brexit around the country. The poorest parts of the country. The people who've gained nothing from the big city life in London, in the City of London, the multinationals and all the rest of it. It's all the small towns spread across the north and other parts of the country who have seen nothing but the devastation of their high streets, devastation of their traditional jobs, low incomes, often people who are older, maybe not as old as me, but certainly 50s and upwards, who've now got not much pension, not much job prospects, and for them, there's been no great benefit from the European Union, no great benefit from these trade agreements and free movement of labour. And of course, there is the racist part of that as well, but there is a certain perception that this is the cause, and so I can't see how the Brexiters can negotiate a deal which maintains free trade and free movement of labour, because that's precisely what part of the vote for Brexit was against, the free movement of labour, and also EU regulations. David Cameron came back with a deal. He said, I've got a deal. The deal is we maintain free trade, and we have reduced the free movement of labour in the sense that anybody who comes from Bulgaria doesn't get benefit for 4 years if they haven't got any work. They don't get British benefits for 4 years. That's a concession made by the European Union leaders. So people won't be from Bulgaria living off the fat of the British benefit system. Which, by the way, relative to wages is one of the worst in Europe. But leave that aside for the moment. They won't be benefiting that for 4 years. If they're still here by then, which of course most Bulgarians probably wouldn't be, then they can start to get benefit. That was the concession he got. Everybody's forgotten about that concession. It's a short-term concession or regulation on the so-called free movement of labour, but of course it's not really very important. But I'll tell you, David Davies will probably do no better than that in a negotiation with the European Union leaders. He could probably get the same concessions. So you can imagine this. They invoke Article 50, they go into negotiations, I don't know, 2 years. They could extend it 3 or 4 years, they could still be in the European Union before I'm dead. But more likely, the European leaders wouldn't put up for that. They want a result fairly quickly. And of course, multinationals want the result. They want to know what's going on. So it's going to be much quicker than that. Then they come back and say, well, we've negotiated a deal. I don't think this is going to happen, but you could negotiate a deal and we've got concessions. You know that we're going to stop Bulgarians taking any benefit for 4 years. And so we end up with David Cameron's deal that we would have had anyway if everybody voted Remain. That's an exaggeration, but I think what we're saying here is that the deal that the Brexiters can get will probably hardly any better than Cameron can get. So most likely there will be no deal with the European Union in terms of what they call the Norwegian option, which is basically you get everything, it's all free movement of labour, it's all free trade, and you still pay money to the EU, and you don't have any rights to change any regulations anymore, but you get the whole thing, the whole package without being a member of the EU, basically, that's what it is. That deal's not going to happen. That's, I think, what the multinationals are hoping for, what a whole section of people are hoping for in the strategies of capitalism. I can't see it happening because it doesn't meet the requirements of the people who voted for Brexit. And so unless they've gone to sleep over the next year because they're so bored with the process, then there's every possibility that there will be no deal on those lines. And Davies will come back to the deal of starting from scratch. Can you just imagine? I'll start with Canada, and we'll see what we can get on that. And then we'll start with Bulgaria. But Bulgaria will negotiate through the EU. So the whole thing is going to be a very tortuous process if we get that far. Now, comrades say, well, in that case, it's not going to happen. This is just a sham. Basically, Brexit will never happen. Well, I don't know. But it seems to me that all the leaders and strategists of capital are saying, well, no, it's going to happen. The one thing that is going to happen is that we're not going to be members of the EU in 2 years' time. The UK is not going to be a member of the EU in 2 years' time. I still think that's what they're going to do. On what terms that will happen, I really don't know. But I can't see a new referendum, Owen Smith style. I can't see just forgetting about it in the hope that nobody's noticed we haven't done anything year after year. There has to be a deal, probably there has to be some decision within a year, I think. I can't see much going beyond that. And the minimum will be that it will be agreed that the UK is no longer a member of the EU. What terms that follows from that, it's just very difficult to say. With US hegemony, it's not so much that the US has a big trading share in the world anymore. It doesn't really. Manufacturing or even in services, we know that US exports are pretty much close to the same level in absolute terms as Chinese exports now. So in the sense of trade, there's not a lot of difference. The difference is, as the comrades have mentioned, is that they are still the financial power of the world, followed by the UK, and the military power. You remember the Roman Empire lost its position in many ways, but because it was a dominant military power and also the financial power, the Roman Empire continued for 100 years beyond its ability to maintain a better productivity than some of the other areas outside or its competition. Particularly the case now since the post-war period. Since the 1970s, the US has been declining relatively as a manufacturing and an industrial power and a trading power, but it's still not lost its position militarily and financially, and those are powerful factors, particularly in the imperialist world, to maintain its hegemony. Tony Norfield has done this book, The City of London, and British imperialism in there, and on his blog site he does what he calls an index of hegemony, if you like, or imperialism, and he takes trade, and he takes the finances, and he takes the military, and he adds them all together for a range of countries, and the US is way, way ahead. Second is the UK, significantly, over any other country in the world. So, if you like, Anglo-American imperialism, it's got a powerful position still hegemonically. The junior partner, which we all are, to the people across the pool, remains our position, even if it's not any special relationship anymore. So that position remains, And it's not so much to do with trade, or GDP clearly, but to do with the financial and military power which exists. Now, just looking again at the question of the British balance of payments, I think the point I was making about global trade, first of all, my original remarks was not that global trade declining means that profitability is declining. In fact, I don't think necessarily the two things go together. What I was saying was, in the globalization period, one of the reasons for globalization, the expansion of world trade and finance and capital movements, was to compensate for the decline in profitability that the major imperialist powers had from the 60s down to the 80s. Globalization is intended to exploit the rest of the world through foreign trade and investment to compensate for the decline in profitability at home. And that has succeeded to some extent. The point I'm suggesting here with the decline in global trade now is perhaps that counteracting factor has begun to disappear. And it no longer is a way out for the imperialist powers. As far as I'm concerned, the biggest issue that the major capitalist economies have got over the next 5 years is not whether they sign trade agreements or not, but whether they avoid another global slump. And a global slump has a much bigger effect. I think the shock on Brexit is going to be bad for Britain for 6 months, or a year, or whatever. A global slump, after just 8 or 9 years after the last one, would be another hit like the 1930s, which is probably going to change the political attitude of people even more than the impact that Brexit might have on the British people internationally. If we have a Hillary Clinton and Theresa May, Mrs. Merkel trying to preside over a new global slump, what's their explanation going to be for this time, and how they're supposed to get out of it? Congress pointed out they haven't really got out of the last one. We have low productivity, low growth, monetary policy, talking about helicopter money, throwing the money out of the windows, or as I say, shopping for growth. You get a coupon, and you go and spend it in the shops, and that's going to boost the world. Or, if that doesn't work, we're going to have a massive fiscal spending. Mr. Hammond and elsewhere is going to announce that we're going to build, I don't know, 65 HS2s all over the country. This, of course, is not going to happen. But the policy of fiscal deficits may well be back on the agenda, or at least not making the 2020 balance that George Osborne was setting before. But that's a different matter from the current account deficit, the balanced payments deficit, the external deficit the UK is running, and the aspects of that which Jasmine was pointing out. First of all, how does the financial services fit into that? Well, in the current account of deficit of 7%, that includes the surplus that the City of London makes for Britain. If you take the surplus that the City of London makes in financial services and stuff out of the equation, the deficit is larger than 7%. It's about 10%. If you look at the goods deficit, it's 10% of GDP. Then we make a surplus on the services that we sell, business services to Europe and so on. That brings it down to 8 to 9, and the financial services bring it down to about 7. So even taking into account the wonderful success of the City of London in laundering Saudi Arabia's money around the world and other services it provides in shifting capital around the world, we're still running a 7% of GDP current account deficit, which is close to a post-war record high since the period of just immediately after the Second World War. Now, we're financing that through flows of capital coming into the country, either in foreign direct investment, which could be in trouble, through people buying, portfolio means buying equities, stocks and bonds, in British stocks and bonds, buying on the stock market in London, buying British company shares, buying British bank shares, buying government bonds in particular, which pay a good interest or have done until recently, over anybody else. That's how we're getting that flows. Plus the fact that if you have a reasonably high interest rate or you have a good banking service, then all these people, foreigners, will put their money into British banks. Or British banks borrow the money in order to make investments around the world. So that's the other investment. As you can see, a lot of these things are a bit vulnerable. So if they start declining, what will happen is the deficit will widen, the pound will go down. A comrade says, well, pound goes down, gee, the pharmaceutical companies will be laughing. because that's one of our manufacturing strengths still in the UK. It's declined, but its pharma industry is an important UK exporting industry. So if the prices fall, pound terms, then the GKNs and the others of the world will be able to export them. True. But will also the price of imports rise on the other side of the equation, so we'll all be spending more money in the shops, and that could lead to decline. So the balance of payments may or may not, or the current account deficit may or may not decline as a result of a fall in the pound. Just after the recession, the pound went down about 15–20%. People forget that. They like to remember it, the Keynesians do. They say, in Eurozone, they couldn't cut the euro, so Greece went down a hole. Britain cut the pound by 15%, and what happened? We still went down a hole. So the argument that a fall in the pound was going to save the day by increasing exports is only one side of the equation. It will also increase the cost of things in the shops through imports, and if the deficit stays high, then there'll be less reluctance at the current rates of interest and so on for foreigners to be kind as strangers to fund our deficit over the next period. And that's the risk. So the budget deficit is less important in some ways than what happens to our external deficit if this situation continues. And this is assuming that there is no global slump in the next 2, 3 or 4 years, or even less in my view. So that aspect has to be taken into account, and what's going to happen to the British capitalist. I don't think British capital looks very secure relative to other capitals in this environment. It's a vulnerable one, particularly because it's based on finance and on the kindness of strangers. To use this phrase I love using now from Mr. Carney about the state of British capital. It's being held up by the kindness of strangers. And those financial services, one of the services we provide is, of course, to provide tax havens and other tricks of the trade. And it's a separate subject maybe about what happens with tax havens, but as we know, what are we going to do about the fact that Luxembourg apparently is making all the profit in the world and there's only 3 people there? So surely there is something wrong with that. Or in Panama, there are millions and billions of dollars being made by Panamanians, but when you go to the companies that are making it, there's just one man and his dog, and nobody else in the office. This, of course, that's not where the money's being made. It's simply an accounting procedure by which the likes of companies book their profits in Luxembourg. How do they do that? Well, they set up a small company in Luxembourg with one minor executive who says, by the way, the company now says we have to pay management fees to Luxembourg, which is our holding company, because they're managing the whole process. So this one person in Luxembourg is charging £3 billion for his management fee, and that goes on the accounting books there. So the profit made by Amazon or whoever it is in the UK disappears, even though we know that the vast majority of the sales and profits of UK Amazon is being made in the UK, with UK employees in UK warehouses on 0 hours contracts. And that is the situation, but the money, the profit is appearing on the Luxembourg account. What's the answer to that? Well, it seems pretty simple to me, assuming we don't get an international agreement as part of TTIP on this, which of course we won't. The answer is that if you employ 10,000 people in Britain, and your sales revenue, which we can record, because it goes through VAT and so on, is 1 billion, then you should pay tax on 1 billion, not on just the fact that you've completely wiped out your profit by shifting all the profit into Luxembourg. So country reporting, as it's called, will be the way in which you can achieve that. And if you can't get an international agreement on that, it's going to be less effective, but you can still start, if you applied it on Amazon, then the reply will be, well, we're all leaving the country. We're not going to have Amazon in the UK because you're taking all our profits away. In America, they have a 35% corporate tax, and all the American companies put all their money in their overseas subsidiaries, so they don't pay the 35% tax. And every 5 years or so, a US president says, I tell you what, we'll do an amnesty. If you bring your money back, we'll only charge you 10% until you can, if you bring it back. So there's 1 year, then they bring it back for a year, then the whole thing starts all over again. You start putting it out. So this process will continue indefinitely until we end capitalism, probably. But nevertheless, you can see that there are perhaps ways in which we could reduce that. So finally, on the question of tariffs, well, I think we discussed whether we can have a Norwegian option or not. comrades can think about that. I think it's unlikely that the UK can achieve a Norwegian option because on one hand, it's not satisfactory to the Brexiters because it means free movement of labour, and on the other hand, why the hell did we get a Norwegian option when we're already in the EU? Now we're not getting anything in terms of controlling or having a say in the EU from the point of view of British capital, and yet we're still having to make the same payments. So the Norwegian option is not. The EU leaders would be happy to probably agree to a Norwegian option because they do it for Norway. We're probably a bit harder on the UK because we've been such bastards. But on the whole, they would agree. But I don't think it can be swallowed politically here. But maybe that will not turn out to be the case. So what happens is, if we have no agreements and we have to go back to the basic, what is the tariff position, comrade Ray? Well, actually, tariffs internationally are very low, about 3 or 4% on average for most goods and services. So the tariffs are no longer an issue because the World Trade Organization and all those deals reduced the tariffs during globalization. They haven't been reversed yet, except occasionally in emergencies. The US puts on 250% tariff on steel, Chinese steel, when it feels like it, briefly. So those sorts of things still happen. But tariffs are very low. It's not tariffs that's the problem. The problem is regulations and inspections. It's a bit surprising, but the European Union and other countries have governments where they don't like you to import goods which are dangerous to people, or cause them to be ill, or don't work, and don't meet a certain standard of technical. So you have to make sure that a good that's coming into the country meets certain standards. And EU has a complete regulations that have been harmonised for this sort of thing, so the whole thing can go through automatically because otherwise the EU single market makes sure these regulations are. Now, if Britain's outside it, the problem it's going to have is it will be like Canada, which is trying to negotiate a deal at the moment, or other countries, saying, well, okay, yes, the tariffs are the same, that's not a problem, but is your British good meeting EU regulations? Well, as it's not an automatic process, you'll now have to go to this warehouse and the guy's going to come down and look at it, and we want to see your documentation, and we'll just go through with it. And finally, maybe after 6 months, your export can come into the country. And as it's not automatic, the next time we want to make a similar export, we have to go through the whole process again. That's the situation which faces if there's no agreements of any sort internationally, and we're just doing it basically, ad hoc as we go. And that's the situation you could possibly, in the worst example, where British exports are in the same position as Canadian exports on the whole, or Australian exports into the EU, where all these conditions are not automatic and have to be continually re-inspected by EU regulations so that they don't kill us. We would be voting Remain. To complete my hat-trick of correct predictions, blown at the last minute. It's a real pain. I predicted that the Tories would win the 2015 election, that Britain would vote Scots would vote to stay in the UK, and Britain would vote to stay in the EU. And I thought I was really onto what do they call it in betting terms? A tripled up job, and unfortunately blown at the last minute. So there you go. Never believe what anybody predicts. And that was a result, as we know, that was quite really unexpected across the board, except obviously for those people out there who were pretty convinced that they needed to make that vote to leave as part of their protest about what has been going on, and as they saw, at least on that question, an answer to the future. Will this vote be disregarded, forgotten, fade away, or be replaced perhaps with a Norwegian-type deal, which means virtually the same thing, only we're just not in the EU, we don't have MEPs and all the rest of it? I don't know. And maybe the comrades who have presented saying, well, it's still possible that we'll get Norway or the whole thing will be forgotten, could be right over a period of time. My impression is that the current government feels that they have to go ahead with this, that they can't go on delaying Brexit in the sense of implementing Article 50 for too long, and that the European Union leaders, although they can't force Britain to do it, will certainly be pretty peeved if there isn't action to implement Article 50 by the beginning of next year. And then the process of negotiation will begin. I'm not sure it can continue for very long. Maybe the Brexiters will come back with Norway and say to the British people, actually, it's Norway. I know, and try to sham it through to say that that's a better deal because at least you're out of the EU, which could be the answer. Maybe that would work, I don't know. I think we should therefore take another longer view and say, what does it mean for British capital if they remain outside the EU and the deal they get with the EU isn't particularly great, it's an old Norway deal. So they have to negotiate a whole range of new trade agreements over the next 5 years. Assuming there's no global slump in the next 5 years, which I think is a very low possibility of getting away without one, then eventually some deals will be reached. British capitalism is not going to collapse. It will find a way in which it can build its position in international trade. The point of my presentation was to say to you that they're in a pretty vulnerable position on their external balance of payments with the rest of the world, an environment where globalization appears to be petering out, and where global trade is declining, possibly not so much because of protectionism, but because the countries that have been slowing down quite a bit are the ones that do most of the trade, like commodity producers, China and so on. So that the trade aspect of the global economy is in decline because these countries are not exporting as much as they were before because they've been slowing down. So it's an integrated effect. And we're seeing a general slowdown in global GDP growth and an even greater slowdown, it will appear, in global trade. Globalization is petering out, capital movements are not taking place, Britain is changing its whole trading arrangement. Maybe it will come back to something more or less the same, but if it doesn't, then it faces a whole new trading arrangement in a very difficult position, and we could have a global slump in the next 5 years. Probably a lot earlier than that. Possibly in Theresa May's run-up to the 2020 election. Everybody's saying, unelectability of everybody. Well, I can tell you, if we have a global slump before 2020, the current government will be very unelectable. My prediction on May 15, after the Tories won, was it was a poison chalice and that they certainly wouldn't win the 2020 election. Well, that's a prediction we can discuss in the next 3 years.